Hello, everyone. I'm going to get started. Thank you all for joining us for our tax presentation for real estate. So I'm just going to run through the housekeeping slide here, and then we'll do some introductions. So make sure that you can see this content. Anything that you need, if you should need some technical support throughout, go ahead and chat that, and we'll try to get you some help. Just make sure your speakers and earphones are on. Enable your audio. There's some directions there. And remember, we're ready and here to answer your questions. So please do use the chat box, and we'll do our best to answer as many as we can throughout. If we do run out of time and we're not able to answer one of your questions that you've asked, we will follow up with you. There's 1 hour of CPE credit offered for the event. So there will be 4 polling questions throughout. You'll need to answer those. And then your CPE certificate will be mailed to you in approximately 1 week. So this is our general disclaimer. I won't run through all of that, but I'm sure you understand. So just to give you a little bit of background, Bonadio is a top 50 CPA firm. We have 10 locations and over 800 employees. I'm Nancy Cox, a partner on our commercial audit team, and I head up the firm-wide real estate team. So our real estate team consists of 26 partners and principals throughout the firm with all different specialties and expertise. We're very lucky to have some of those experts with us today from the Bonadio real estate team to lead us through this presentation. So Cheryl Prout and Leah Powell are partners on Bonadio's tax team, and Kyle Young and Roger Upton are partners with MS Consultants, which is a cost segregation study practice. So let's just go to the agenda. There's a lot of things to cover, so we'll try to do it quickly. And as I said, please do not hesitate to ask questions, and if we can't get to them, we will answer you after the presentation. So I will give it to Cheryl, who will start with agenda item number 1, which is the CARES Act tax law changes for real estate owners from 100,000 foot view. So go ahead, Cheryl.
Okay, thank you, Nancy. Okay, so we'll start first with just a general overview of what we will cover as part of the CARES Act tax law changes, and then we'll get into additional details as we go along. As part of this CARES Act, there were quite a few favorable items that were enacted for taxpayers, and many of them revolve around operating losses and being able to utilize them, carry them back, and also generate additional losses potentially. So a few of the enacted changes are in regards to the excess business losses. So excess business losses that were incurred in 2018, 19, and 20 are no longer limited. And there's also a better chance to generate some of these losses. Net operating loss carry forwards, the limitations there were relaxed a little bit under some of the new revenue procedures. Individual NOLs being generated in 18, 19, and 20 can now be carried back up to 5 years, which previously they were not allowed to be carried back starting in 2018. And also their next slide there, Kyle, thank you. And then the qualified improvement property that Kyle and Roger will talk about a little bit in conjunction with cost segregation studies, and the bonus depreciation and specialized lives that come into play now under the CARES Act. And then Leah is also going to cover some of the changes regarding interest expense limitations under Section 163J, as well as we will cover a little bit about amending tax returns and also revoking and changing some of the prior elections that may have been made on the 2018 returns, because under the CARES Act, there's some ability to go back and change these previously filed returns. So getting into the first category here in regards to net operating loss carrybacks. So under the tax law changes that came into play in 2018, the tax rates were significantly reduced. So previous to 2018, the highest tax rate that we had seen in a while was 39.6%. And then when 2018 came online, the tax rates were reduced to 29.6%. So there was a good 10% cut in the tax rates. So older tax dollars, meaning in years prior to 2018, are potentially worth a lot more in tax dollars and potentially refundable dollars if you are creating or generating NOLs in these more current years like 2019 and 20 and able to carry them back to older years. And we'll get into that a little bit when I go through an example. And essentially, the difference in the 39.6% to the 29.6% is really a permanent tax savings because of that tax rate differential. Also, when you go through the analysis of these net operating losses and whether you want to carry them back, whether you want to change some of these elections that I had mentioned to generate additional NOLs, and whether or not you just want to carry them forward or use them more currently, you really have to assess the differences in these tax rates and really the time value of the money and when you're going to be able to utilize those, and also when you're going to be able to potentially get cash refunds in your pocket because of these. So we'll go through an example here just to kind of talk about the things that I had just mentioned. So in this example, if the taxpayer has $500,000 of qualified improvement property, that's the QIP, and we'll get into that definition in a little bit more detail as to what that property entails in later on in the presentation. But essentially, the CARES Act has allowed a depreciable life of 15 years and also the eligibility to take 100% bonus depreciation write-off. And as a result, you can also go back and amend 2018 to take advantage of that. So in my example here, if in 2018 you previously had $350,000 of taxable income, and now you have the ability to go back and amend that tax return and potentially take $500,000 of a deduction for this qualified improvement property, that will shift you into having a net operating loss for that year. So you could also, because there's multiple options that you could do, so that's one option. The other option is then to keep 2018 intact, but then report in 2019 either by amending a 2019 return if you've already filed, or on the originally filed return to just catch up that $500,000 deduction by filing a Form 3115 or amending and filing that in 2019 to create a loss, potential loss, I should say. So in my example, 2019 had $900,000 of taxable income. You could just file in 2019 and take that $500,000 deduction potentially and just offset some of that taxable income. Or you also have the option of waiting until 2020 and catching it up all in 2020, since we haven't filed that yet. Now, in 2020, many people, are thinking they're going to be projecting to have a loss already. So this could potentially just create an additional loss. And again, you just have to assess the three different options and just see what your best results are from a cash flow perspective and a utilization perspective. So you need to assess that and really have discussions about all of that. And then just a reminder that the state rules are all different when it comes to both the CARES Act and the previous TCJA Act. And just to be sure that the state isn't a coupling, and or if they have slightly different rules, or possibly they follow the rules directly. Every state is different. And then the last piece is in regards to excess business losses. Now, excess business losses was something that came into play in 2018. And what that states is that an excess business loss is really your total business income less your deductions. And previously, you were limited to only be able to utilize $500,000 on a joint return or $250,000 on a single return. And that was the maximum you could use. And then anything in excess of that would carry over into future years. Now under the CARES Act, they've done away with that, and you can use your NOLs fully. So not only is this $500,000 limitation gone, in addition to that, there was previously on the carry forward, there was a limitation where you could only use 80% of your income in future years when you carried it forward. That is also gone under the CARES Act. So they've just really made it a lot more taxpayer friendly when it comes to utilizing all of these NOLs. So in regards to the NOLs, so these are different ways that we can potentially utilize them to our advantages. And then we're also going to talk now, the other speakers are going to discuss ways of potentially generating these NOLs and ways of, going back and amending and changing some of the elections and things that have already been filed.
Perfect, Cheryl, thank you.
Yep.
We'll go on to polling question number 1, and just reminded everyone, if they've maximized their screen to view just the presentation, that's on the, if you scroll down towards the bottom, you can view your options and click the polling to submit the answer if you do want CPE. The question is, will you be amending tax returns to maximize NOL carrybacks? I just opened the poll up, but in the concern of time, we're going to leave that open for 2 minutes, but move on to the next set.
All right, welcome everybody. Before we talk about the 163J changes to the interest expense limitation, I think it would be helpful to have an overview. This was just brought in with the Tax Cuts and Jobs Act of 2017, so it's relatively new. It applies to businesses with annual average gross receipts greater than $26 million. If you operate multiple businesses with common owners, do be aware that related party rules do exist, and you could be tripped up and be subject to these new limitations. It also applies to tax shelters who have more than 35% of the losses going to non-active investors. The business interest expense is limited to business interest income plus 30% of a new term called adjusted taxable income, plus for auto and equipment dealers, floor plan financing interest expense. Adjusted taxable income begins with preliminary taxable income. You add back your interest expense, and in years before 2022, you can also add back depreciation, amortization, and depletion. Now, this is important to note that once a tax year beginning January 1st, 2022 begins, many taxpayers are going to find that their interest expense is going to be significantly impacted by not being able to increase your adjusted taxable income by depreciation, amortization, and depletion. So it would be an incentive to get any projects that are underway in service and be able to claim, especially if you are able to take accelerated depreciation, bonus, QIP, all those type of things that were just enabled recently, into reducing your taxable income. If you can do this before 2022, it's to your advantage. There is a way then you can avoid the business interest limitation. Real estate entity may make an irrevocable election to take 100% interest deduction in exchange for using slower ADS depreciation methods. But if you do this, you're not able to take bonus depreciation. So what changed? Business interest expense in 2019 and 20 is now able to be offset against business interest income. Now 50% of adjusted taxable income plus floor plan financing. Taxpayers are also allowed to elect to apply the adjusted taxable income of 2019 in the 2020 taxable year. And why would you want to do this? We'll go through an example in a little bit, but presuming their 2020 income is going to be less than 2019, it's nice to have the option to use a higher base to start with. Partnerships can use the 50% limitation beginning in 2020, but can deduct half of the interest expense that was limited in 2019 in the 2020 year. And also taxpayers can elect out of the real estate exception they may have made to take advantage of the new QIP and bonus rules, which, as Cheryl mentioned, will be discussed later. So let's go through some examples to illustrate these changes. The first example will illustrate the impact of the increased adjusted taxable income limitation from 30% to 50% for the 2019 tax year. Again, this doesn't apply to partnerships, that they're not effective until 2020. So in both examples, under the old rules, they have $500,000 of interest expense. They start with preliminary taxable income, $400,000. Again, we add back our $500,000 interest expense deduction, add back our depreciation, amortization, depletion, and come up with our adjusted taxable income of $1.2 million. Using the 30% limitation, we would be able to deduct under the TCJA rules $360,000 of interest expense, leaving a $140,000 deduction on the table. Now, with the CARES Act, our limitation is increased to 50%, bringing our limitation up to $600,000, which is in excess of our interest deduction. We're able to deduct it all. Now we'll go on to the next example, which illustrates the impact of, in the 2020 tax year, being able to choose between the 2019 adjusted taxable income or the 2020 adjusted taxable income limitation. Again, the interest expense is $500,000. In 2020, we're starting off with a break-even point for preliminary taxable income. Again, we get to increase this by the interest expense deduction and our depreciation amortization, bringing our adjusted taxable income up to $800,000. Applying the 50% limitation would give us a $400,000 interest expense limitation if we use the 2020 adjusted taxable income year. But we also have the ability to use the 2019 taxable year, and in 2019, we actually made $400,000 of preliminary taxable income. Adding back interest and depreciation, we bring our adjusted taxable income now up to $1.2 million, multiplied by the 50% limitation, gives us a $600,000 limitation, fully allowing the $500,000 interest deduction incurred, so all of it is allowed. Our next example is on the partnership side. Assuming the last example, if we were a partnership, we would have had $140,000 of interest expense suspended for the 2019 year. Now again, for partnerships in 2020, they also have the ability to elect to use the adjusted taxable income of the 2019 year or the 2020 taxable year. Again, starting with $500,000, zero preliminary taxable income. Our 2020, our adjusted taxable income is $800,000, 50% of which would be fully deductible. So of the $500,000 incurred in 2020, $400,000 would be deductible. But remember, we had $140,000 from the 2019 tax year carried over, and we are able to deduct 50% of that. So our interest deduction is $470,000 for the 2020 year, leaving $100,000 carried forward to 2021. If this partnership would like to use the 2019 adjusted taxable income, it can increase its deductible contribution. The limitations increase from $400,000 up to $600,000, and would be able to fully utilize the $500,000 from the current year and the $70,000 carrying over from the prior year. So that's certainly a good answer for this situation. Won't go into too much detail here. It just highlights that the CARES Act did provide a lot of flexibility, given that there's a lot of factors to look at in deciding whether or not to make the real estate election, to get out of the interest expense limitation, or using the 30% limitation or the 50% limitation or the 2019 ATI or the 2020 ATI. The IRS understands that there's a lot of things to consider and is being very flexible, allowing late elections and also allowing you to withdraw an election that may no longer make sense. So the next slide won't go into more detail too in the interest of time, but it does point out the due dates for making the late elections and making, withdrawing a real property exception election if you had previously made that. But I will leave you with a planning point. And as you can tell, with all these changes in the rules, it's hard to determine whether a taxpayer is going to be better off with the unlimited interest expense deduction or foregoing and being subject to the limitation, in order to, get depreciation deduction. So, if you have QUIP property receiving now a 15-year life, which is eligible for federal bonus depreciation, making the election exception becomes a planning point. Do I have any future QUIP on this particular commercial property? If yes, when and how much? If I have a future QUIP, can I do a cost segregation study to drive the cost down into 5 or 7 year property eligible for bonus? Take a closer look and determine whether or not any cost improvements are actually repairs that should be fully deductible, considering the ADA and other Section 179 limits. There's just a lot to consider in making all these decisions. But, the long story short is the IRS is providing a lot of flexibility in allowing taxpayers to really take a look. It's really going to become a multi-year exercise to determine where you're going to get the most bang for your buck.
Thank you, Leah. Polling question number 2. I'll get that read here real quick for everyone. Again, don't forget to submit once I do open it. Would you like to generate more deductions to take advantage of the NOL carryback opportunity? B or C? Yes, no, maybe. It's important. It's nice. With the CARES Act, we have these opportunities to recoup taxes paid, increase our cash flow. I know there's businesses out there that aren't open yet or are just opening and maybe at 50% capacity or even less. So getting those deductions or getting those dollars back is key, whether it's reducing estimated payments in the future or actually going back 5 years for NOL. A lot of great opportunities, and the IRS has been pretty good with the explaining, and that's what this slide is about here. Before I go on, we have about 1:15 left for that poll. Don't forget to hit submit if you do want the CPE, and we do have 4 questions, and if you do want the CPE, you have to answer each of those 4. So with these revenue procedures, the IRS has come out with 3 that we're highlighting here, and I know that you can't read it. We will send the whole summary to you in a follow-up email, but it details out revenue procedure 2020-22, 23, and 25, and applicable dates, as well as explains how we can take advantage of some of these nice incentives that Congress has provided to us. So on to QIP, Qualified Improvement Property. It took a pandemic and I think 17 different tries through the House or Senate to get it to pass, but the pandemic did ultimately allow some cohesion and teamwork within Congress to get this to go through. What QIP is and does, it is interior structural improvements. I'll get the definition actually in the next slide. But it's for assets placed in service after 2019 or after 2017. I'm sorry. They'll have a 15-year life now instead of a 39-year life, with bonus applicability in 18 forward. If you do have the 163J exception election, that is a 20-year life for ADS and no bonus applicability there. So QIP was initially introduced in 2016, and it's for commercial property that have interior improvements after which the building has been placed in service. We usually get a question here about, well, if I bought a building and I do improvements immediately, can those be eligible? The answer is yes. If the building initially was placed in service by another taxpayer, that means it's in service and giving you the allowability to take this incentive and deduction. It does not include the 3 E's, expansion, elevators, or external improvements. Escalators are also not applicable. And QIP is very similar to QLI, but a couple notes that are much better. First, you can have it on your self-owned property. where a manufacturer or office building, might be housed in the facility. So we'll take the manufacturer as an example. They own the building and they have their operating company and have the real estate. They can take advantage of it for interior components that are eligible. The other difference, and quite honestly a great improvement from QLI, is the removal of the 3-year in-service requirement. This QIP only has 1 day. There's a nice example right in the Revenue Procedure 2017-33. Those are the things that most people fall asleep to at night. But Roger and I, in particular, like those revenue procedures. So let's get into the importance of knowing when we're doing improvements, whether they're leasehold or for your own property, they tend to include some of those 3 E's. In our experience, we're 20 to 40% of the improvement costs when somebody says, oh, we did improvements, or they might say, we did leasehold improvements and stick it in that GL account. Some of those include those exterior components, the rooftop HVAC units, the chillers, roof work or windows. All those items are not eligible for QIP. So it's important to review the scope of projects, whether it's internally or with your tax preparer or CPA. Make sure that these items are properly classified. Quite honestly, they could be expenses that are deemed repairs. They could also be 5-year or 7-year personal property, or even some land improvements stuck in there. So we've developed a nice flow chart that we will also send around with the revenue procedure memo. It kind of goes through not only the definition, but a little bit of a decision tree to help guide the answers. I guess it guides you through the answers, and if it's yes or no, there still could be additional incentives that are applicable, whether it's, again, applying tangible property regs so we can maybe expense it, or if we do have to capitalize, maybe we can write off some components that were replaced. A lot of great opportunities here, again, with the goal of increasing deductions and maximizing cash flow or cash retention. Here's a real quick example of a cost seg study that breaks down building components, and this one is a improvement. So we likely had an AIA document with 16 different construction categories broken out. And we go much deeper than that. Here we list those categories and then the life in this 39, 15, and 5. In this $1.2 million, I think it's a gym renovation, we broke out almost 50% is Q eligible property. And that's great news, right? A lot of deductions. In this case, it's 100% at this moment, so that's $623,000 of depreciation right there. There is 18% that remains at that longer life, though. And if we didn't do the study, the potential is you take the whole 1.2, almost 1.3 million as 100% eligible, leaving a little bit of risk out there of 228. That's, I'll say, not safe, I guess. But what we also have is almost 33% of 5-year property. And New York State, for one, it couples from bonus depreciation. So they have, the treatment is better at 5-year than 15 for state purposes. I want to point out one quick thing before we do switch slides, is that our engineer-based studies that we do, these cost segregation, break out the components into your next year, even if your contractor doesn't do that. Here with HVAC, we have the exterior, likely rooftop units here, and then the interior ductwork and diffusers and other components that can have that 15-year treatment. We also do the same thing with doors, quantifying and valuing each of these components, as well as breaking out anything that is considered either structural or exterior.
Hey, Kyle, this is Roger. We just had a question come in, and I think Paula sort of hit on it at the beginning. You always have to be worried about state issues. since most of the people listening in today are based out of New York, how is New York treating QIP?
Great point. I should have mentioned that, so thank you for the question. With QIP, New York State is keeping it at the 39-year life. They have come out and decoupled from the QIP, the new QIP treatment within the CARES Act. So this remains at 39 years, giving an even more incentive and reason to break out that 5, because for New York State purposes, it would be, $850,000 basically at the 39-year life, where that cost seg study can break out that 400 and again get it at least over the 5-year term instead of all at 39. Great question there with New York State. A little unfortunate there, but all these changes did come in quick. The states are reacting to make sure that they can keep revenue coming in. I think that's a great answer for us taxpayers. Polling question number 3, we'll get right into. Are you interested in a follow-up from one of our Bonadio real estate experts? Just opened up. We have 2 minutes on the clock there, and I will move on with this. Don't forget to hit that submit button if you do want CPE, and we're going to go on to Roger to talk about UNICAP and constructed buildings.
Unmute. Thank you, Kyle. And also, once again, if you do have questions today, feel free to use that chat box. We already answered one question. And if we can't get to all the questions today, because we are trying to keep this to an hour, we will get back to you on an individual basis with some answers for you. And so let's talk about UNICAP and constructed buildings. Now, what is UNICAP? UNICAP is the part of the tax law that says if you are constructing a building from ground up, you have to take all your indirect costs, such as interest and real estate taxes and engineering, permitting, and even the porta potties that you're using on your site, and capitalize those costs into the cost of your building. All right, that's Code Section 263, large A. It's been around for 20 plus years as far as UNICAP is concerned. And as you can see here on the bottom, those costs can easily be 7 to 40% additional cost to the hard costs that you've incurred for your building. So these UNICAP costs are very significant when you're constructing a new building. However, under the TCJA, there is a new rule. And the rule is very similar to what Leah brought up with her Section 163J in the interest rule. And basically what the Congress intended here is that smaller taxpayers, and the definition of small taxpayers in very general terms is basically $26 million or less of gross receipts, do not have to follow a lot of rules. Some of them might be, I can be on a cash basis, as Leah showed, you might not have to follow the 163J rules. And now under UNICAP, you are not required to capitalize all your indirect costs anymore into a building. That can be a tremendous answer. So the next question then is this: if I don't have to capitalize all those soft costs, the permitting, the engineering, the architect, and all those kind of costs into my building, what happens to them? Well, the IRS has some very good guidance there. They say a lot of these costs are now, this is the first entity that you are building, those costs are now considered what we call startup costs. Section 195. Section 195 costs are written off over 15 years. That's a lot better than 39 years. However, at the same time, interest and real estate taxes are not considered startup costs. They can be written off immediately. So if you think about it, once again, I've incurred all these indirect costs. First building I'm putting up, I don't have to capitalize these costs anymore. They go into either a 195 bucket, or I get to have an immediate deduction of those. Once again, a great start. Let me give you an example of a client who's actually based out of the Rochester region. They have a single LLC, single partnership, that has 6 constructed warehouses inside of it. Applying this new rule there, okay, the first building that they put up they incurred about $247,000 of costs that no longer have to be considered part of the building. The IRS now will allow us to write those off under Section 195 over 15 years. So that's a really good start there. However, on top of it, this taxpayer also incurred $65,000 of interest expense, which had previously been capitalized into the building. Now that taxpayer can write off that $65,000 immediately. Well, as we said, there's actually 6 buildings in this property. So what happens on the next 5 buildings, the property itself, the entity itself is no longer in startup mode. So all the additional UNICAP costs incurred in the future for the next 5 buildings no longer even goes under Section 195 because we're no longer starting up. All those costs are now expensable. That was another $650,000. So by the time we get done there, remember one thing that is happening there is we are reducing the basis in these buildings. So we are losing some depreciation, but we're gaining an immediate deduction. In this particular situation, not only did we gain a $600,000 immediate deduction on these 6 warehouses, we also gained it for state purposes. So it was a huge win for this particular taxpayer. If you can just go to that. Okay, great. So what happens now under UNICAP? Because this is sort of an interesting idea here. What does the IRS say? If we don't have to follow UNICAP, what happens? Well, first of all, as you can think in my example, a lot of these buildings were built in prior years. The IRS says you can go back. You're supposed to act as if UNICAP never applied. You now go back to your previously capitalized buildings and pull out these soft costs. That's great. Well, then, of course, that leads to the next question. Roger, I understand it. I can appreciate that, but my client does not want to go back and look through the records to figure out what happened in the prior years. Can I just use it on all the new buildings going forward inside of that entity? And the answer is no. You're not allowed to use what we call, that would be the cutoff method. We're not allowed to use the cutoff method here. However, if you are interested in doing something like that, maybe the next building should be built under a new entity, which starts up your whole accounting method separately from the old entity. That's an interesting idea. Lastly, we keep on saying these have to be brand new constructed buildings. Well, wonder if I just bought an existing building and I just want to improve it. I'm not going to spend $1 million improving it, but I'm just going to improve it. Can I write out that permit, those engineering costs, all those kind of things? The answer is no. Under a separate part of the law, those costs still have to be capitalized. So once again, this UNICAP idea only applies to new construction. Great. So that's one topic. That's one way. And once again, these topics we're bringing up here are just ways to bring additional deductions to you, the real estate owner, without going out of pocket real cash. Next thing here, you know what? I'm going to take a second here just for a 10-second plug. Who are Kyle and I? We are not, as Cheryl and Leah are tax partners within the Bonadio firm. Kyle and I are actually directors in MS Consultants. MS Consultants is a firm that exists to support real estate operators nationwide. Okay, we are actually the back room for over 200 CPA firms nationwide, helping their real estate clients save taxes, mostly through cost segregation study, which Kyle's going to talk about, but through other energy tax savings, repair and maintenance, things of that nature, these UNICAP ideas that we're talking about, all those things come into play. Once again, we work on a national basis. Over the last 20 years, we've done over almost 17,000 studies nationwide. Anyways, thank you for that. Allow me to do a plug there for MS Consultants. Here's the next topic, Section 1031. 1031 is actually an idea that a lot of real estate operators have either used or definitely understand. It's the ability in the law that says, hey, listen, I am selling a building, and if I follow specific rules, I don't have to recognize a gain on the building. I can actually just roll all those proceeds into a new piece of real estate. Really a great opportunity because the IRS does not get their hands on that tax on that gain currently. The gain is actually deferred into the future. Now, prior to 2018, the 1031 rules existed for real estate. They existed for trading in cars and automobiles. They existed for even things like franchise fees, like in a hotel or a restaurant situation. You could do a like-kind exchange and defer that gain. Well, what happened is, starting 2018 under the Tax Cuts and Jobs Act, the Congress tightened up that rule much more. They say, listen, we're only going to allow you to exchange real estate for real estate. Well, what's a real estate? Sort of a litigated thing. States have a different definition of real estate than federal government does. So what happened is, actually, last week, the IRS issued 48 pages defining what real estate is for a Section 1031 exchange. And what it is basically the building itself, the structural components of the building. So think about like your drywall, your bathrooms, your basic lighting, your basic heating, things of that nature, the roof, things of that nature, land improvements, and land. So those are really your four categories: building, structural components of the building, land improvements, land are now your definition of real estate. Items that you previously have depreciated either 5 or 7 year property, and that's usually things like carpeting or maybe cabinetry or appliances, things of that nature. Those cannot be exchanged into the new building. You actually pay tax when you sell those items. So that all being said, let's talk about what the old law said and what the new law says, and I still think we're better off under the new law. Now, to prove our point there, we're going to just go through an example. Let's say you happen to have a building that you've had for a long period of time. The remaining basis in the building is $2 million. And you're fortunate enough that somebody wanted to buy it for $7 million. That gives you a huge gain of $5 million, of which you wanted to defer that gain and come up with an additional $3 million in cash and debt to buy a new building for $10 million. So that's great. You're getting rid of a $2 million, a building that you had $2 million basis in it. You probably paid off the mortgage. You probably don't have much depreciation left. You come up with $3 million and you're ending up with a $10 million asset. That's a terrific answer. All right, that was the 1031 rules. Under the old rules, this is what would happen. Okay? Okay, thank you. Under the old rules, we would take, you ended up with a $10 million asset. We would take away that $7 million that really represents your exchange property, and now we're down to the new $3 million of cash and debt. Now, on the previous slide, we said the new building has 10% personal property and 90% building. So out of the $3 million, we would sort of apply that rule here and say, okay, 90% is building, $2.7 million. Personal property, $300,000. That's a really good answer. We ended up with $300,000 of personal assets in the new building, new cash and debt that we put into the building, and we got to defer a $5 million gain. That's a nice situation. However, now under the new rules, what's happened here? Kyle, if you don't mind, I'm just going to show something. See where the $7 million is falling now into the second line? Kyle, can you just go back to the previous slide for a second? Great. The $7 million under the old rule came off the whole $10 million. However, under the new rules, that $7 million now is applied only against the building. The $1 million of personal property you had in the original $10 million of new building, you are actually going to use part of your new cash and debt to buy that $1 million of personal property. Why? Because you can't exchange into it. You have to buy it. So we're going to use out of our $3 million, we're going to buy $1 million of personal property, and whatever is left over is going to be applied to building, which is $2 million. So what's happened between the old and the new law? Well, the next slide shows under the old law, your $3 million of new assets, you would have had $2.7 million of building, $300,000 of personal property. Under the new law, remember, we have to buy our personal property at fair market value. We did for $1 million, which means our building is only $2 million. And remember, personal property purchased under a like-kind exchange is subject to the 100% bonus. So in this particular example, this taxpayer, by following the new rules and not the old rules, has just generated a $700,000 deduction, greater than the old rules. And then on top of it, what's happening here is this. Out of that $2 million, out of the $3 million being spent, okay, 1/3 is being written off under the new law. That is a great answer. And that's why 1031 exchanges under the new law are really beneficial. And then we have one more idea we would like to talk to you about here before Kyle finishes up talking about the big idea, which is cost segregation studies, is repair versus capitalization. What's really interesting here is under repair versus capitalization, okay, starting in 2014, the IRS really made changes that are very beneficial to the real estate owner. And what those rules basically say is a lot of things that we might have capitalized in the past, we now can write off as a repair. Now this grid here shows you and once again, this is over 1,000 pages of law that we're condensing down into one page. That's not a good, all right, so please remember, this is not a 100,000 foot view, this is a 1,000,000 foot view. We're up in a spaceship looking down at the United States right now. But let's just talk about a couple of the examples here. In the past, if we spent $100,000 putting on a new roof membrane, we could capitalize it. Why? It was $100,000. It's a new roof. Let's capitalize. Under the repair rules, they say no. The roof membrane is really just part of the roof. All right. It's really just like putting shingles on a house. It's not a new roof. It's just part of the roof, and therefore you should be able to write off your roof membrane rather than capitalizing it. On the second line there, let's say you might have 10 roof units on your building. As long as you're replacing only 2 or 3 at a time with very similar type of HVAC units, even though you might be going out of pocket $10,000 or $15,000 a pop for an HVAC unit, think about if you own an apartment building and you have all those P-tax, they're all going to be expensed. Why? Because more than 70% of your HVAC system is still operating correctly. So it's sort of interesting. The IRS has almost come up with a rule here that says almost a third or 1/3 rule of changes. If it's a third or less, you may be able to end up with an expense. Now I'm going to show you what happened when we reviewed one particular taxpayer's fixed asset records here. We were able to, by going through these fixed asset records, we were able to say, hey, wait a second. You didn't need to capitalize that roof. Let's write it off. There's $135,000. Even though it happened in prior years, the IRS says you still might be able to correct that this year. Hey, there's another $41,000 of items that might be you capitalized a couple HVAC that you didn't need to, or maybe you changed over one bathroom in your office building with 5 or 6 bathrooms. You didn't have to capitalize that. You can write that off. The cost segregation study, Kyle's going to talk about that in a second, generated another $82,000. So when they got all said and done here, these particular taxpayers ended up with about $250,000 worth of deductions for items that they'd already spent the money on, but now the federal government is sharing in the tax burden, and they got back over $90,000 in tax savings in the current year, and because they peeled off over $250,000 off of the books and records for that building, they lowered that building's basis, and now they have a much larger capital gain rather than depreciation recapture on sale, and so they'll probably benefit another $10,000 to $12,000 in tax savings sometime in the future. So once again, just another tool to have in your bag. Take a look at your fixed assets. If you've owned something for a while, there might be things on there that you've capitalized in the past that maybe we can write off now going forward. And with that being said, Kyle, I will let you take it away. And Kyle, you might be muted. Maybe, yeah, Kyle, you're still muted.
I am muted. Yeah, I just had a great speech. You didn't hear it though. Polling question number 4. I do thank everyone for being on. The question is, are there any tools you'd like us to contact you on to discuss potential benefit opportunities? Cost segs, TPRs, the tangible property regs that Raj just went over, other expensing opportunities, QIP, and so on. You see them there. You know, just looking back at the agenda here, we talked about NOLs and excess business losses, and even the ability to adjust our 163J election. Those are right now they're temporary as it stands. The time frame to deal with those and the opportunities to go back and recoup some of the tax dollars paid. So a lot of these other tools that the QIP and cost segs that I'm going to talk about, and the UNICAP, those are vehicles that are available and remain, at least for the foreseeable future, as vehicles to either reduce taxes, but again, to look back and recoup the taxes. There is a short period of time to take advantage of some of these CARES Act opportunities. A little less than...
Kyle, I'm sorry,
Yep.
Kyle, I think we got enough time here to fit in a question before you get into cost segs. It has to do with your QIP. That's what I want to talk about now. The person wrote saying, hey, listen, our business, we just bought a building. We're going to renovate it for our own office space. So I guess it must be a real estate company or construction company. And then we're going to move in. And so therefore, we've never used the building. We're going to renovate it and then move in. Is that still QIP or no?
A portion of it at least can be. Because the building was already placed into service, that does meet the initial definition of QIP. But we do have to remember that it does have to be interior non-structural. Things like that. Roger and I review depreciation schedules and review questions like this with clients. We'd love to the opportunity to review your particular situation to identify the potential benefit for you. But in general, yes, but be careful that that you're following all the rules there. Great question.
So Kyle, just continuing with that question, the building, I don't have to be the person placing the building in service?
That's correct. It can, as long as the building was placed into service by a taxpayer, not necessarily you as the taxpayer. So again, an old federal building downtown was in service. You now acquire it. It can be, as long as again it was placed in service by a taxpayer, then anything you put into it can be eligible. Good point that you don't have to own the building to get QIP. You could be a tenant. If you're paying for those improvements, that QIP does have eligibility there as well. So moving on to cost segs, and we still will respect your time and end at or before 3 o'clock. And do again appreciate everyone's attendance. Cost segregation studies. That's the ability to allocate acquired or constructed assets into their proper, usually shorter depreciable lives. For new construction, that's reviewing actual cost detail, the AIA document I mentioned earlier, and breaking that down into those 16 categories that show up in the AIA. But then we break it down into probably 1,000 or more other assets, literally every outlet. We trace it back to the electrical panel and detail out whether it's 1250 or 39-year property. Sorry to get to text talk there. 39-year property, or maybe it's related to process wiring or computer wiring, and then it can have that personal property status. For acquisitions, we actually have to have our engineers reconstruct the building essentially using IRS-approved costing softwares like RS Means or Marshall and Swift. I think that has a new name now. Actually, did I say that out loud? But I'm just going to go through an example here. I think I'll get to the example in a minute. So as I talk about that's engineer-based study, the rules are very complex. Where we have CPA like Roger, tax professional like myself, and engineers that tend to be traveling this time of year, especially that we've opened up with Corona at least a little bit. These engineers and construction specialists price out, and together with our tax expertise and familiarity with the tax law, can come up with benefits that can exceed 30, maybe even 40% of acquired or constructed property that can go into those lower lives. Those lower lives not only reduce the lives and increase depreciation over a life, but then can be bonus depreciation eligible if they're again in that 15 or 5-year type bucket. Here's the different property types. In 15-year lane improvements, we see still a lot of lane improvements being depreciated over the longer life, the 39-year or 39 or 27 and a half, where things like paving, storm drainage, they can be fixed. Here's my examples I was referring to. A little bit busy with the bubbles, but I'll go through it fairly quickly for you. This is a $7.5 million acquisition from 2016, where if we hadn't done a cost seg study, and this is usually where we review a depreciation schedule and find this, they have this building on the books. It's a commercial building at 39 years. They would have depreciated less than $500,000 over that time. So 1, 2, 3 years go by, total almost $500,000. If we do a cost seg study, we're assuming here we're going to allocate about 27% to the various 5, 7, and 15-year buckets. We can adjust that depreciation all the way up to $1.1 million. That change, you're like, well, how can we do this? And what's the method in the vehicle to catch this up? Again, this is available pre-CARES, post-CARES, and whatever the next tax act is. We perceive cost segs being available. We can actually go back all the way to 1987. We usually don't think that's necessarily advantageous. But let me finish this example here. That's $650,000 of additional depreciation. We can pick this up all in 1 year with filing a Form 3115. That can turn into, and that's I'll say it's a easy form for me, but Cheryl and Lee, I don't think you raise your hand if you enjoy doing 3115s. I don't think they're going to raise their hand. So Roger and I produce a lot of those a year. I think we're up past the 5,000 mark of just 3115. What this does, it's an automatic change, goes on to the tax return. That can pick up, assuming 40% tax rate, $320,000 of taxes either that you paid or that you don't have to pay later. It essentially shortens the life. Again, we're still depreciating the same $7.5 million. We're just moving 27% of it up to shorter lives. In this example, the benefits do continue to increase because the 5-year and 15-year treatment, we're only in year 3 in this example. That's an acquisition. Remember in 16, we didn't have bonus depreciation on used property. Here, this is a new construction, same example, just new construction, same numbers, but with the incentive of bonus depreciation in 2016, it was at the 50% level, that bumps up the total depreciation that we can get after a cost seg study, almost 1.8 million. So almost 1.3 of additional depreciation we can pick up again through that 3115. That's over $500,000 of tax benefit in that first year. Now, I mentioned used property can get bonus depreciation now as part of TCJA, Tax Cuts and Jobs Act. But it's not every asset that gets bonus depreciation. If it was, maybe a cost seg study wouldn't be needed. But in this example, we have a building, $7.5 million still. Only the assets with a life 20 years or less are eligible for bonus depreciation. So that other 73% does have to remain at the long life. Again, we're still depreciating the same 7.5. We're going to pick up at this level. This current treatment is 100% bonus depreciation is allowable. So we're going to go over 1.1 million just or 2.1 million, in the first year. That's just under $2 million of additional depreciation, saving almost $800,000 of tax dollars. And again, with bonus depreciation and these cost seg studies, unlike 179 and other treatments, there's no limitation to this. So this can create nice losses that again can be utilized in the vehicle of NOLs to pick up those dollars from the past. So I kind of mentioned a few of these big reasons to do cost segs. We can catch up on missed bonus depreciation. We can create permanent tax savings. We can be utilized, as Roger had in his examples, for 1031 exchanges. They allow for future write-offs where our reports are essentially recyclable, and again, they maximize the opportunities with CARES Act, TCJA, and any applicable law that is continuing.
Wonderful. Well, thank you. And it's perfect timing, Kyle. So any of the chat questions that we were unable to get to during the presentation, we will follow up afterwards and make sure that we get back to you with an answer. And we encourage you to reach out to us if you didn't put anything in the chat and you do have questions, to please let us know. Obviously, there are tons of tools available. There's tax benefits and advantages for developers. And you can see just from this slide, there's a lot of things that we weren't even able to cover. So if you do have specific questions on any of these things or want to talk any further, we do encourage you to reach out. We would be happy to help or answer any questions that you have. I also wanted to let you know before I forget that a copy of the slides and the recording will be sent out within the next few days, just so you're aware that you will be receiving that. So in summary, I mean, it's all about freeing up cash, right? So not every tool that is available will apply to every situation. However, there should be something that you could be taking advantage of at this time. I mean, there's just a lot of opportunity out there. So make sure you consider how you can maximize losses, including potentially going back and amending 2018 returns. So with that, just another reminder that we would really appreciate your questions. We would be happy to chat with you, and we thank you so much for attending. Thank you.